A paycheck lands in a checking account on a Friday morning. The number is larger than it was 2 weeks ago. For a brief moment, the balance looks strong. There is space. There is flexibility. The money sits there, visible on a banking app screen, waiting to be moved or spent. Later that day, an automatic transfer executes. A fixed percentage moves from checking to a savings account. Another portion shifts into a brokerage account. An email confirmation arrives. Transfer completed. No decision was required in that moment. The movement happened because it was scheduled weeks ago. When transfers are manual, the sequence looks different. The paycheck arrives and remains in checking. Bills are paid. A few purchases are made. A dinner out. A subscription renewal. A small online order. By the time someone opens the investment app, the balance feels smaller. The transfer is postponed to next week. Automatic transfers change the order of operations. Money moves first. Spending adjusts around what remains. The visible checking balance never appears inflated. The baseline shifts quietly downward before habits have a chance to expand. There's something subtle about that shift. Most people do not track the exact day their money leaves checking. They notice the paycheck, they notice the purchases. The scheduled transfer happens in between, often unnoticed. It becomes part of the background activity of the account. Over months, the brokerage dashboard begins to show a pattern. On the 1st of every month, a deposit appears. On the 15th, another one. The chart does not spike dramatically. It steps upward in small increments. The steps look ordinary, almost repetitive. Manual investing often depends on mood. Some months feel financially focused. The app is opened. A transfer is made. Other months are busy. The reminder notification is swiped away. The spreadsheet is not updated. The pattern becomes irregular. Irregular deposits create gaps on the chart. Weeks pass without contributions. When markets dip, hesitation increases. The transfer is delayed again. The balance remains in checking, exposed to everyday spending. Automatic transfers remove that pause. The investment purchase settles whether markets are rising or falling. The trade confirmation email arrives without commentary. Shares are bought at different prices across the year, sometimes higher, sometimes lower. The activity continues regardless of headlines. The difference in timing matters more than it appears. When money sits in checking, it is fully available. It can absorb impulse purchases. It can fill small budget overruns. It can quietly disappear through a series of ordinary transactions. When money leaves checking immediately, it becomes less accessible. It lives in a separate account. Retrieving it requires logging into a different app, initiating a transfer, waiting for funds to clear. The extra steps are small, but they create distance. That distance shapes behavior. A saved credit card number shortens checkout time. A stored password speeds up access. Friction works in both directions. Removing friction from investing and adding it to spending gradually shifts outcomes. On a monthly bank statement, the difference is visible. In one scenario, transfers appear as recurring line items, consistent in amount and timing. In the other, deposits into investment accounts vary, sometimes large, sometimes absent. The pattern tells a story about structure. Compounding does not require dramatic returns to begin. It requires capital to remain invested over time. Automatic transfers increase the probability that capital actually arrives in the market on schedule. Missed months are reduced. Gaps narrow. Open an investment chart and zoom out to 5 years. The growth curve reflects both market returns and contribution consistency. Two investors earning similar returns can end up with different balances simply because one account received deposits more reliably. Automatic transfers also scale quietly with income. When the percentage is fixed rather than the dollar amount, a raise increases the contribution automatically. The paycheck grows. The transfer grows. The visible checking balance may feel similar to before. Without automation, a raise often first appears as a larger checking balance. New recurring expenses can form around that number. A higher rent, a new subscription, a slightly larger car payment. The adjustment happens gradually. On a budgeting app dashboard, recurring transfers appear in the same section as recurring bills. They are treated as fixed obligations. In effect, saving becomes a line item similar to utilities or insurance. It occupies scheduled space. Manual saving often sits in a different category. It is listed under discretionary or variable spending. When a month feels tight, it is the easiest item to reduce. The transfer becomes optional, subject to evaluation. Optional actions are sensitive to fatigue. After a long workday, opening a brokerage app to initiate a transfer can feel unnecessary. The account balance is reviewed briefly, then closed. The money remains where it is. Automatic transfers do not depend on that decision point. They execute whether the day was productive or exhausting. The system runs in the background while attention is elsewhere. There is also the question of market timing. When investing is manual, it is tempting to wait for a better entry. The chart is checked. News headlines are scanned. The transfer is delayed by a week, then another. Scheduled transfers ignore short-term predictions. Shares are purchased on preset dates. Some purchases occur before declines. Others occur after. Over time, the average entry price reflects many small decisions made in advance. Transaction histories make this visible. Scroll through 12 months of automatic contributions and the entries look uniform. Dates repeat. Amounts repeat. The market price at each purchase varies, but the pattern of participation remains steady. Manual transaction histories often show clusters. Several contributions appear close together, followed by long periods of inactivity. The gaps represent time out of the market, even if unintentionally. Cash sitting in checking earns little. It feels stable. It is immediately accessible. But over long periods, its purchasing power changes. Funds that reach investment accounts begin to work differently. Even modest returns compound when contributions are regular. The effect is not visible in the first quarter. It is barely noticeable in the first year. Over longer stretches, the slope of the chart becomes clearer. Automatic transfers also simplify tracking. Net worth spreadsheets become easier to maintain when deposits occur on known dates. Projections rely less on intention and more on established patterns. Without automation, projections assume future discipline. The spreadsheet shows what would happen if a certain amount is invested each month. The condition remains hypothetical. In contrast, recurring transfers turn that assumption into an ongoing event. The spreadsheet reflects activity already in motion. Forecasts align more closely with actual behavior. Over time, the psychological weight of saving decreases. When transfers are automatic, there is less need to revisit the decision. The money is already in motion. Attention shifts elsewhere. Manual saving often reopens the decision every month. Should the full amount be invested? Should expenses be covered first? The internal debate repeats. Some months resolve differently than others. Looking at a decade-long account statement reveals the cumulative effect of those repeated choices. Consistency, even in modest amounts, produces a smoother upward path than sporadic larger contributions. Automatic transfers do not eliminate uncertainty. Markets still fluctuate. Account balances still decline during downturns. The difference lies in participation. Contributions continue through those periods. When markets recover, the shares purchased during lower prices are already in place. They were acquired because the transfer did not stop. The structure carried the investment through volatility. In the end, automatic transfers are not dramatic. They do not create headlines or milestones. They create line items. Recurring, predictable line items that accumulate quietly. Open a banking app on an ordinary weekday. A small transfer has already happened. The balance has adjusted. No announcement was made. The movement occurred because it was scheduled. Over months and years, those scheduled movements define the shape of the investment chart more than any single decision. The growth reflects repetition. The repetition reflects structure. A paycheck arrives. A transfer executes. An email confirms it. The pattern repeats. The speed of wealth building is not always about larger returns. Sometimes it is about reducing the distance between earning and investing and allowing that distance to remain small. The difference becomes visible slowly on dashboards and charts that update in the background. Automatic transfers do not feel faster in a single week. Across years, the cumulative effect stands out in the balance history. The system continues whether attention is focused on it or not. And in the account statement, the regularity of those entries tells its own story.